Welcome to Talk Tickers. Today, we're digging into Lloyds Banking Group's Q3 2025 earnings call. And let me tell you, this was a fascinating one. The headlines all screamed bad news, but if you looked at the stock price, well, it told a completely different story. So, we're going to figure out what was really going on. Okay, so here's the mystery in a nutshell. On October 23rd, Lloyds comes out, announces a huge new £800 million provision, and even cuts its main guidance. You'd expect the stock to get hammered, right? Wrong. It actually closed up over 1%. So what on earth did the market see that the headlines missed? Let's get into it.
First things first, we have to talk about the elephant in the room. This is the motor finance issue that completely dominated the news cycle and frankly spooked a lot of people initially. So, in the third quarter alone, the bank had to set aside another £800 million. Now, this is all to cover potential cost from an old motor finance issue that the UK's regulator, the FCA, is looking into. It's a massive number, no doubt about it, and it definitely grabbed everyone's attention. And when you add that to what they've already set aside, the total provision for this one single issue is now just shy of £2 billion. But here's the interesting part. It's all about how management talked about it. They basically walled it off, framing it as a legacy problem, a contained issue that they just have to work through.
And this quote from the CFO, William Chalmers, just says it all. He's like, look, we're not happy about this. It's unwelcome. But in the very same breath, he pivots and says the underlying business is an absolute machine, just churning out capital. It was a masterclass in separating the past from the present.
And you know what? The market listened. Investors looked right past that provision to see what was going on underneath. So let's pop the hood and look at how the actual business is doing, because this is where the real story of the quarter is. So when you look at the actual report card, Lloyds really delivered. Earnings per share, right in line with what analysts expected. Net income, which is basically their top-line revenue, they actually beat expectations. And on top of that, they showed they're keeping a tight lid on expenses, with operating costs dropping 1% from the last quarter. Solid. And the core banking engine? It is absolutely firing. Net interest income, the money they make from lending, was up a really healthy 3% in just one quarter. Their net interest margin, which is a key measure of profitability, actually expanded. And their capital buffer, that CET1 ratio, is super strong at 13.8%. This is the stuff investors love to see. Now, this is the kicker. While the headline guidance got cut because of that big provision, management turned around and actually raised their guidance for the core business. They're now telling the market to expect better returns, higher income, and better loan quality for the full year. I mean, talk about a signal of confidence in their underlying operations. It was a huge statement.
But it wasn't just about a strong quarter. The call also gave us a really clear picture of how Lloyds is trying to transform its business for the future, to become more than just your standard high street bank.
They laid out three key moves. First, they're making a massive push into wealth management. Second, they're getting right in the middle of all the innovation around digital currency. And third, they're doubling down on technology, so much so that they're holding a special event just to talk about it.
And that Lloyds Wealth deal is a really big deal. They managed to take full control of this pretty substantial wealth business without spending a single pound in cash. They used a share swap. This is such a smart move to grow income that isn't tied to interest rates, and to really target that wealthier customer base.
Okay, so we've got a strong core business and a clear strategy for the future. So what's next? Well, there are a few key dates coming up that anyone watching this stock needs to have circled on their calendar.
So that tech seminar in November will be interesting. But the big one, the one everyone is waiting for, is getting a final answer on that motor finance mess. We should get the final word from the regulator in early 2026. Once that cloud of uncertainty is gone, you can bet the conversation is going to shift immediately to capital returns. You know, dividends and buybacks.
All right, let's put it all together. After digging through that call, what's our take on Lloyds? What's the thesis, and how should you think about it?
You've basically got two competing stories here. The bull case is all about that fantastic core performance, the strong capital generation, and the smart moves into wealth management. The bear case? It's really just one thing, that motor finance issue hanging over everything. It's an anchor of uncertainty until we get a final number.
So for us, this all nets out to a market perform rating. The strength of the core business is absolutely real and the market sees it, but we think the stock price is probably stuck in a range until that motor finance liability is fully known and quantified. The good news is already baked in, for now.
But hey, if you're looking for an interesting way to play this, here's an idea. You could think about a pair trade.
You go long on Lloyds, betting on its quality and its new income streams, and at the same time, you short a UK challenger bank that's way more exposed to risky, unsecured loans. It's a way to bet on Lloyds' relative strength and resilience in the UK banking sector.
And of course, this is not financial advice.